Hi, everyone. As a mortgage broker, I talk to real estate investors daily. Many are frustrated with traditional lending. They have a great rental opportunity, but their personal income or debt-to-income ratio holds them back. If that sounds like you, this video is for you. Today, we're diving deep into residential DSCR loans. We'll give you the information you need to decide if this new financing option from Wall Street is right for your portfolio. Let's get started. First, let's step back and understand the frustrations real estate investors have with traditional rental loans. Fannie Mae, for instance. They qualify you based on your personal income, expenses, credit scores, debt-to-income ratio. This is tough, especially for the self-employed, for retirees, and for those with non-U.S. income. Traditional rental lenders want to see steady recurring income for 2 years, and they don't want borrowers to hold title in LLCs. Now, these newly fangled residential DSCR loans from Wall Street are different. DSCR lenders focus on the property's ability to generate rental income to cover its debts. Debt service coverage ratio, or DSCR, is a simple calculation. Take the property's rental income and divide that by its expenses. That includes principal, interest, property tax, insurance, and HOA fees. A higher ratio signals a safer investment for you and for the lender, and they reward that with a lower interest rate. And what's great is that these DSCR loans can work even if the property is currently vacant. The lender will order a market rent survey to determine the income portion of the DSCR ratio calculation. The typical lender requirements include a 680 or higher credit score, 20% or higher down payment, 6 months or more of PITI reserves, principal, interest, property tax, and insurance, and HOA. Because these residential DSCR loans are relatively new, there's a lot of misinformation out there. Let's bust some of these common myths. Myth number 1, it's a no-income home loan. Nope. While loan qualification doesn't rely on your personal income, it's a business loan, and the property must be ready to produce rental income. Also, these residential DSCR loans are for investment properties only. The borrower must demonstrate clear business intent. Prior rental experience is a plus. And myth number 2, any property can qualify. Nope. The property must be safe, habitable, and ready to produce rental income. That means no fixers. These loans are also limited to residential properties 1 to 4 units. No apartments with 5 or more units, and also no mixed-use properties, such as those properties where there's a unit of residential on top and 1 unit of commercial or retail on the ground floor. That won't work. Be sure to watch our video on DSCR appraisals, where we discuss the top 3 deal killers and share up our top 3 expert tips to ensure a smooth appraisal for these residential DSCR loans. Now, let's talk about the pros and cons. First, the pros. Definitely, it's easier qualification for a lot of people. Second, LLC ownership is okay, and this helps with real estate investors' liability protection. Third, short-term rentals are okay. You just need 6 to 12 months of operating history to demonstrate the income potential for the DSCR calculation. And fourth, there's no limit on the number of properties you can finance, whereas traditional rental loans, they limit you to no more than 10 financed properties. These features address the common pain points for real estate investors. Because of that, DSCR loans are a solid alternative for those who don't qualify for traditional rental loans. But there are some downsides. First, they have higher interest rate than traditional rental loans. Second, they almost always have a prepayment penalty period, and these can last up to 5 years. and they can be very stiff penalties. You can sometimes negotiate for a shorter penalty period or a lower rate with a higher interest rate. And third, you must be prepared with 6 to 12 months of PITI reserves. And honestly, this is for your protection. If you don't have 6 to 12 months of reserves on these residential DSCR loans, maybe this is not the right time for you to invest. So let's be very clear. There are significant risks if you don't use these residential DSCR loans judiciously and protect your real estate portfolio with significant holding power. Specifically, there's no minimum ratio for the DSCR. There are even no ratio DSCR loans. What if your property tax goes up? What if your property insurance goes up, which we know has happened quite drastically for many property owners? DSCR loan approval ignores repair and maintenance, ignores property management fees, and ignores utilities. So all these mean that your property may have severe negative cash flow, even if it qualifies for a residential DSCR loan. And all this negative cash flow could affect your ability to qualify for future loans, especially your home loans. And if you have too many of these DSCR loans without proper reserves for repair and maintenance, for property tax and insurance, they could burden you to bankruptcy. So here is our top expert advice for you. First, if you can qualify for a conventional rental loan, do it. They often have lower rates and better terms. Second, budget for everything, include property management fees, repair and maintenance, utilities. Build in a margin for potential rate hikes in property tax and insurance, building reasonable vacancy factor, and building reasonable inflation. And third, get expert advice. Don't go it alone. Before you make an offer or refinance, call us. We at Abundance are seasoned real estate investors, and we have seen a lot. The good, the bad, and the ugly. We will help you understand your options and guide you to the best of our ability. We will tell you to walk away if we don't believe you're financially ready.